Welcome back to the Deep Dive. We are tearing into the latest earnings calls and strategic shifts. And today we're focused on Mitek.
Yep, the Q4 and full year fiscal 2025 results. They dropped after the market closed on December 11th.
And this is a really interesting one. It feels like a company in the middle of a huge strategic pivot, and the market, well, it definitely noticed.
Oh, it noticed. The initial reaction was strong. But, there's a lot of nuance here. It's not just a simple beat. This is about a company trying to redefine its entire story.
Okay, so let's start there with the headline numbers that got everyone excited. What were the key figures that drove that initial pop?
It was a really clean beat on the top and bottom lines. The big number was non-GAAP EPS. Came in at 24 cents.
And the consensus was what, 18 cents?
Exactly. A very significant beat. And then revenue, $44.8 million, which was nicely ahead of the $40.7 million Wall Street was looking for. So solid 4% growth year over year.
Okay, but I have to jump in on that right away. The non-GAAP number was great, but the GAAP EPS was what, 4 cents? Down from 18 cents a year ago? That's a huge gap. Is there anything to worry about there?
That's a fair question, and it's something you always have to look at. But in this case, it's pretty straightforward.
Okay.
That variance is mostly non-cash stuff. Stock-based compensation, amortization of things they've acquired. It's pretty typical for a tech company that's investing and growing.
So the story investors are focused on is the underlying cash profitability.
Precisely. The non-GAAP figure is what shows the real operational, cash earning power of the business. And that story is all about quality growth. That's why the stock closed the next day up nearly 9%.
Let's talk about that quality growth then. Because for a software name, quality usually means one thing.
Recurring revenue.
Yeah.
And they delivered. SaaS revenue was up 19% year over year in the quarter.
That's the signal.
That is the signal. That predictable, high-margin growth confirms the whole strategic shift is actually working. It's not just talk.
And that shift is really the core of the story here. I mean, they've fundamentally changed how they even talk about their business.
They have. For years, you thought of Mitek as two things, right? Identity and then check deposits.
Right. Two separate silos.
Now they've officially changed their reporting. It's fraud and identity versus check verification. This is so much more than just a branding exercise. It's a re-rating mechanism.
So explain that for us. Why is changing a reporting segment name so important?
Because it changes the entire lens you use to value the company. Customers don't buy point solutions anymore, not the big ones anyway.
They don't want just one widget for identity and another for check fraud.
Exactly. They want a holistic platform that manages fraud across the entire customer journey. So by reporting this way, Mitek is telling the market, this is how our customers buy from us. We sell an integrated platform.
And you can see that playing out on the full year numbers. The mix is fascinating.
It's perfectly balanced. For fiscal 25, revenue was split right down the middle. About $90 million from check verification and about $90 million from fraud and identity.
So the new growth engine is now officially the same size as the legacy business.
That's the perfect way to put it. The check verification business is this incredibly stable, cash-generative machine. It's still handling, 1.2 billion mobile check deposits a year? It's infrastructure.
It's the flywheel.
It's the flywheel that funds the future. And that future, the fraud and identity segment, is the growth engine. It grew 15% year over year for the full fiscal year.
And that growth is powered by that SaaS acceleration you mentioned.
It's the most important trend here. For the full year, SaaS revenue growth actually accelerated to 21%.
Wow.
Yeah. And that's pushing the mix. SaaS is now 43% of total revenue.
Yeah.
They're well on their way to their goal of having about half their revenue come from high-quality recurring streams.
And this isn't happening in a vacuum. There's a massive macro trend basically forcing this demand.
Oh, it's an enormous structural tailwind. I mean, management was very clear about framing their whole unifying growth strategy against the rise of AI-enabled fraud.
Deepfakes, synthetic IDs, all of it.
All of it. They even cited an estimate that AI-enabled fraud in the U.S. could hit $40 billion by 2027.
Just to put that number in perspective for you, $40 billion it's larger than the market cap of many well-known tech companies. This is a systemic threat.
It is. And you can't fight AI-powered fraud with a single signal. You just can't. That's why demand is surging for these multi-signal workflows that bring together documents, biometrics, liveness detection.
The whole integrated stack.
The whole stack. That's the game now. Increase the value, the dollars you get from every single workflow by providing richer insights.
Which brings us to product. If fraud and identity is the engine, Check Fraud Defender, CFD, is kind of the flagship product, right?
It is, and the traction is really starting to accelerate. Annual contract value for CFD grew 50% year over year.
50% is a strong number.
It's very strong. But the metric I'm watching, the really strategic number, is network coverage. Their configured data sets now cover over 25% of all U.S. checking accounts.
Okay, and here's the part that really stood out to me.
I think I know what you're going to say.
When you add in the banks that are currently in the pilot phase,
It approaches 50%.
50%. Why is that number, even with pilots, so critical? It's more than just a big sales pipeline, isn't it?
Oh, it's everything. It's the definition of a network effect. In fraud, the value of your solution grows exponentially with the size of your data.
The more you see, the smarter you get.
Exactly. If you can see what's happening across half of all U.S. checking accounts, the intelligence you generate is just exponentially better for every single bank in the consortium. Once you hit that kind of critical mass, it becomes almost impossible for anyone else to catch up.
That's the moat.
That is the moat. It creates defensibility, it creates pricing power, it's the whole game.
Now, they did mention a bit of a speed bump. Some of the big deployments didn't quite make it in before year end.
Right. Some large enterprise CFD deals slipped into fiscal year 2026, and, that affects the timing of revenue. But they were very clear, this doesn't change the underlying demand. It's just selling big infrastructure to big banks takes time.
Okay, so shifting away from growth for a second. FY25 was also about cleaning house operationally.
Yes, and they executed really well. Adjusted EBITDA margin hit 30% for the year, which is $54 million. And the cash flow conversion was, frankly, exceptional.
100% conversion, $54.2 million. That seems almost too good to be true.
Well, and management basically said as much. They were quick to guide that 100% isn't sustainable. They expect it to normalize more around 75% long term.
Which is still a very healthy number for a software company.
A very healthy number. The 100% got a temporary boost from some, working capital timing and some tax benefits. So I think 75% is the right benchmark going forward.
And there was another huge operational milestone, something that might seem boring, but is critical for institutional investors.
It's non-negotiable for the big money.
Yeah.
They announced they have fully remediated all the previously reported material weaknesses in their internal controls.
That's huge.
It's a massive signal that says, we've cleaned house, our processes are rigorous, and you can trust our numbers. It de-risks the story significantly.
So with that strong foundation in place, let's talk guidance, because this is where the market's initial excitement got a little bit tempered. FY26 is the investment year.
That's the perfect summary. They're taking that strong cash flow and deliberately plowing it back into the business, specifically into R&D, AI, biometrics, and into their go-to-market and sales teams.
So what do the guidance numbers look like?
For fiscal 26 revenue, they're guiding $185 to $195 million. That's about 6% growth at the midpoint. But importantly, the fraud and identity piece is guided to $101 to $105 million.
So that's maintaining that roughly 15% growth rate.
Exactly. The growth engine keeps humming.
But the investment comes at a cost to near-term margins. We saw 30% adjusted EBITDA this year. What's the guide for 26?
They're guiding to a range of 27% to 30%, so a slight step down. And what that implies is that EBITDA dollars will be roughly flat year over year.
So they're choosing to hold profits flat this year.
To invest for faster growth and bigger profits in fiscal 27 and beyond, it's a classic investment trade-off. Prioritizing future capability over maximizing every margin point today.
Makes sense. And finally, let's touch on the balance sheet. There's been this convertible debt issue hanging over the stock.
Right, the $155 million that matures in early 2026. But that's not really an issue anymore. They ended the year with $196 million in cash and investments. They're in a net cash position.
So they have the flexibility to just take it out.
Full flexibility. They can use cash on hand, their credit facility. That overhang is effectively gone. It removes a key risk for the street.
So if you put this all in context, how has Mitek actually performed versus its peers during this whole pivot?
It's pretty stark, actually. They've significantly outperformed the software sector ETF, the IGV. Over the last year, Mitek is up over 13%, while the IGV is basically flat, up maybe 1%.
So the market is rewarding this specific story.
Yes. It's rewarding the execution on this pivot to a high-growth, recurring revenue platform. It's separating Mitek from the rest of the pack.
So if you were to connect all the dots for us, what's the final strategic takeaway?
The thesis is that Mitek is successfully re-rating its business. It's about compounding that network value with CFD and then increasing the dollar value of every transaction with richer multi-signal products. And yeah, that mix shift to SaaS puts a little bit of pressure on gross margins. It was 84% versus 86% a year ago, but the quality and predictability of that revenue is worth so much more in the long run.
All right, that brings us to our final segment. And as always, a clear disclaimer. This is just us analyzing the public information. It's for informational purposes. This is not financial advice.
Absolutely. But if we're putting on our thinking caps, here's the outrageous but plausible trade idea. The street is still underestimating the operating leverage that's coming when that CFD consortium hits critical mass.
The 50% pilot coverage number.
That's the leading indicator. And those big enterprise deals that slipped have to get signed in fiscal 26. The bet is that this all happens at once.
So what's the actual trade?
You initiate a long position using highly leveraged call options. I'd look at expirations after their Q2 2026 report comes out.
And the thesis is a synchronized inflection.
Exactly. First, the pilot banks convert to paying customers, pushing fraud and identity revenue way past the high end of their guidance. Second, they officially retire the convertible debt, removing that last piece of risk. The combination forces a rapid re-rating of the stock's multiple, and the options provide an asymmetric outsized return.
A high-risk, high-reward bet that the leading indicator becomes realized revenue fast.
That's the asymmetry in the story right now. It's all about execution.
Well, that brings us to the end. To recap, a big Q4 beat, clear acceleration in SaaS, and a strategic pivot to fraud and identity that is clearly working. Fiscal 26 is the year they invest to capture that massive AI fraud tailwind.
And the final provocative thought for you to chew on is this. How quickly does that massive data coverage from the Check Fraud Defender network translate from just a leading indicator into actual recurring revenue? And what does that inflection point mean for Mitek's next leg of growth?
A great question to end on. Remember, this deep dive was based on the source material our listeners shared, and it is not investment advice. Thanks for joining us. We'll be back soon with more.